Good afternoon, good evening, good morning to you all, dear IFA friends. Welcome to this first IFA webinar series, a conversation on international tax practice. Perhaps before we get into the details of the session, let me give you a bit of a background story to this event, because of course it's the first IFA webinar series, so it deserves some explanation. Well, there is a scientific and a technical explanation to this event. The first, perhaps, is the technical one. As a result of the COVID era, the IFA studio emerged and gave us tremendous opportunities to reach out to the IFA membership. And of course, at the same time, we also realized the need to communicate with the membership on a more frequent basis, and to address current development in a way probably that we were not used to do in the past, namely not waiting until the annual Congress. And this event has been built in that spirit and in the strong belief that there is a need to debate international tax development as they unfold. Today's session is about international tax practice and some important court decisions, but we will have other IFA series with a conversation driven by international tax policy development. So the background basically is to be able to reach out to the membership and to debate with you important developments as they unfold. Now, let me give you perhaps a flavor of the content of the event. We have selected one tax treaty case and three important transfer pricing decisions, because we believe that these decisions combined are extremely important to international tax practice. And the way we want to do this, you will see, is I've asked the panelists, who are well-known IFA friends, and the presenters as well, to actually always follow the same pattern, so to speak. So you will have a presentation of the facts of the case, the findings of the court, and perhaps more importantly, the impact on the local and global landscape. And that's where actually the panelists will stimulate the discussion and provide inputs as to the future possible consequences and impact of these cases on international practice, whether in international litigation, mutual agreement procedures, or even arbitration cases. For this event, I have the pleasure of being assisted by Luisa Scarcella, who, together with the IFA Secretariat, has been doing a wonderful job to put us all together, and so that we appear in a structured fashion. So thank you very much for all the background work that you've been doing to make this event possible. I think again, IFA is the perfect place to do this and to debate this. And again, also, I would like also to thank the branches, the IFA branches, who have helped us to select the speakers, underscoring, of course, the tremendous importance of the IFA region and potential to provide input in this area. Now, let me give you perhaps just a sequence of today's program. So you have seen the program. We will be beginning with a landmark court decision delivered by the Indian Supreme Court. This will be our treaty case. I will introduce the panel at this point in time. And then we will be having three transfer pricing decision, the Glencore decision in Australia, the Coca-Cola case in the US, and finally the Cameco and Agracity cases in Canada. With that, we'll have a wrap-up of the session, of the transfer pricing session, also being joined by Matt Andrews from the OECD. But perhaps before we get live into the session and the concrete discussion of the cases, I think it's also, speaking of the OECD, perhaps a very nice time just to take a small flavor of what's happening at the level of the OECD. And for that, I would like to give the floor for a few minutes to Sophie Châtel. I've been delighted to have the pleasure to work over the past years with Sophie in the Permanent Scientific Committee. Sophie was the head of the tax treaty unit of the OECD and will now be joining the Ministry of Finance in Canada. And I'm delighted perhaps to give her the floor for a few minutes just to report on what's happening at the OECD level. So Sophie, please, the floor is yours.
Merci Robert, and hello everyone. It's a real pleasure to be here with you. And to talk about what Robert mentioned is what was the update of the tax treaty work. And when we talk, Robert and I, we realize that most of our work in the tax treaty revolve around, of course, the taxation of the digitalization of the economy, those challenges. And so I'll start with a brief update on the Pillar 1 and Pillar 2 blueprints that were discussed in January in the public consultation. And then I'll move to what else we do, because we do other things than just the digital economy. But briefly, the public consultation, the main theme there was the Pillar 1 and Pillar 2 proposal, but especially the Pillar 1 were quite complex. And so the task force on the digital economy and the inclusive framework setting really worked on finding ways to simplify these proposals. So the work is ongoing, of course, and we were waiting for the change of position by the US and the new Biden-Harris tax administration. And that was significant. It came, you are aware, it's well known in online, but main element was focus on Pillar 2 and the intention of reinforcing the guilty regime, but while doing so, a better alignment with the Pillar 2 provisions. So that was good, such as the jurisdictional blending. They propose a higher rate, and there will be discussion on the substantive carve-out, of course, where there's a bit of misalignment there. But what was important also is that the Biden-Harris administration really insists that it's part of a package. The Pillar 1 and the Pillar 2 go together, so it's not only that M&E has to pay a minimum level of taxation, but of course, it has to be allocated in the right place. So in that sense, they came with a new proposal for scope that is both broad in the sense that they include many activities, many more that were in the blueprint, but also more narrow in the sense that they really target the most profitable and the largest M&Es. With that new scope, there will be simplification, for example, on the need of segmentation or that accurate segmentation. So that's good, but also new challenges in the revenue sourcing for components, for example. But what's important is that the US position was welcomed by the members of the inclusive framework. And what we've seen over the months, the last years are really key areas of consensus emerging from the technical discussion. Like this is time to tax the large and profitable M&E on a consolidated basis. It's time also to look at that more in a formulaic approach. It's after the public consultation too, what was important is that we have to design practical revenue sourcing rules. On Nexus, broad agreement on a Nexus that would be based on a revenue threshold. There was also importance of tax certainty, early tax certainty to prevent dispute, the need for a coordination, very important, and probably meaning a multilateral convention, and the removing of unilateral measures to be defined. So work continues, of course, on further simplification, dispute resolution that applies more broadly, elimination of double taxation. It's still a complex area, so work is ongoing. And country, I think that's the key. They realize that if we want stability in the international tax system, it has to go through a global solution. So two key meetings to keep in mind is the finance minister, the G20 finance minister meeting in July and in October. So a key meeting there to reach a global solution. That's not the only thing that we do in tax treaty at the OECD and with our delegate of Working Party 1. You've seen the release of the tax treaty guidance for COVID-19 situation. So if you wonder, if you're an employer, you wonder if a home office of one of your employee trigger a permanent establishment, you'll find answers there. And also specific country guidance, which is helpful. And finally, there's a lot to say, but I'll just focus on this one because it's on the ongoing public consultation. Is Working Party 1 has released, the inclusive framework has released the new commentary or proposed commentary to Article 9 and some consequential commentary to Article 25, and you have until 8th of May to provide comments. So that's all I'll have to say, but I could spend hours to talk about the many files we have, but those are the main ones. Robert, back to you.
Thank you very much, Sophie. So yes, we will monitor the digital debate, and I think the end of November, beginning of December virtual event will be a good time to take stock. So I think it's time to move to the core of our session. And the first case, I have the pleasure of introducing the panel. So this will be about the Indian Supreme Court royalty case. I prefer to call it that way instead of listing the entire name because everybody knows what I'm talking about. Let me introduce to you the panel composed of well-known IFA friends. I will introduce them in the alphabetic order, but that's not the way in which they will be opining. So pleasure to welcome Mr. Mukesh Bhutani, who is the chair of IFA India and the managing partner of BMR Legal. He will be taking us through the impact of this case, both at the national and international level. He will be giving a presentation of 15 minutes, and then we will be joined by panel members to explore the possible international ramification of the case. So in alphabetic order, Peter Barnes, he is an international tax advisor and off counsel at Kaplan Drysdale, and he's also a senior lecturer at Duke University, and not to mention, he is the future president-elect of the International Fiscal Association. Sophie Châtel, whom we were joined, who will also join us for a short comment on the case. Johan Atting, he's an associate professor of law at the University of Cape Town, and he's an advocate of the High Court at the High Court in South Africa. Adolfo Martin Jimenez is a professor of tax law at the University of Cadiz, and he's also the chairman of the European Association of Tax Law Professors. And here I emphasize again the strong and natural ties between IFA and ETLP. So very happy to have you again in one of our panels, Adolfo. And also another IFA friend who doesn't need an introduction, Jonathan Schwartz. He's a barrister practicing at the Temple Tax Chambers in London. So this is our panel. I think we are well equipped to have a very nice discussion. The problem is always time, but I hope we will manage. So I think it's now a right time to turn to you, Mukesh. So the floor is yours to take us through this fabulous Indian case.
Thank you very much, Professor Robert Denon. First, thank you for inviting me. I just hope that I'm able to do justice to this 250-page or judgment in 15 minutes. Nevertheless, it's important for me to mention that this judgment was not about one case. It encompasses over 100 cases that were there. Next slide, please. So very broadly setting the context, what were the issues that the Indian Supreme Court was facing? It was facing essentially two issues: whether there is a withholding tax obligation on part of the Indian resident or non-resident that was making payment for software, which was held in favor of the taxpayer. And there is a related judgment of 2010, which I'm going to talk about, which did not want to get into the merits of the characterization of royalty payment. And hence, the 2021 judgment assumes significance, where it actually held that this is not an income in the nature of royalty insofar as the non-resident service provider is concerned, or the non-resident recipient of the royalty income is concerned. And while holding it, the court did get into aspects such as definition of the term royalty under the domestic law, definition of the term royalty under at least 18 treaties, because this bunch of 100 odd cases was dealing with treaty countries of 18 nations. And finally, the court came to a view that even under those treaties, it was not held to be royalty. Next slide, please. Now, this slide is a bit crowded, but I will take very briefly to explain the entire history of the domestic law on definition of the term royalty. So up until 1976, the domestic law in India did not tax royalty. And the law was introduced in 1976 as a strict source-based rules. In the 70s and the 80s, many countries introduced this at a time when the network of the treaty, particularly for an emerging market like India, was not as widespread as it was in the post-economic reforms of India, which is after the 1990s. Now, this definition has three elements to it. The word software was obviously not there in 1976. The word software did come into origin when India embarked on economic reforms in 1990. So 1991, when India was just aspiring to be a player in the software industry, the word computer software was introduced. Thereafter, when the dot-com era emerged in 2000, the definition of computer software was modernized, and we saw another amendment. The watershed development, which is the genesis of this dispute, really occurred in 2012 when retrospectively the law was amended. And I have specifically used the word for the removal of doubts. It is hereby clarified because alongside this retrospective amendment, there were three clauses that were amended. For the sake of the decision that we are debating today, only one clause is relevant, which is clause number 4, Roman 4, where it expanded the definition of the term royalty to declare that it included transfer of all or any rights for the use or right to use a computer software. This one sentence came up for debate before the Supreme Court in the context of domestic law and in the context of treaty as well. And hence the question before the court was, how do you really characterize royalty income that is earned by non-residents where the source lies in India, undoubtedly under the 1976 law, in light of the retrospective amendment of 2012, which took us back to 1976, because the 2012 amendment essentially said that this is removing the doubt. It is the law that is being declared. It is the law that stood as at 1976 when it was legislated. A related development was the 2010 decision. The reason it is important is because in 2010, the federal court, the same court, had an opportunity to examine it, but from the point of withholding tax obligation. At the time of that examination, the federal court just interpreted the domestic law and said, well, the domestic law talks about a withholding tax obligation that arises if income is chargeable to tax. And if income is not chargeable to tax, there is no question of a withholding tax. The court at that point in time did not want to get into the merits of the case, neither did it want to entertain any request whether this interpretation chargeable to tax is in the context of domestic law or in the context of treaty. Next slide, please. Now, this slide is very interesting. Having been faced to deal with a batch of over 100 cases, how do you really decide? Agreements are different. Contractual obligations are different. There are distributors, there are sub-distributors, there are B2C contracts, there are B2B contracts. So for the sake of convenience, the court requested us to put it in an organized manner in various categories. Thereafter, the court said, well, all this batch of cases will fall in this category. So if you do not fall in this category, let us know in which category you fall in. And if you do not want to be a part of the batch of appeals, you can choose to exit from these appeals. Barring a couple of taxpayers, all the 100-odd cases came up together in these 4 batches. Batches which entailed end users, where the Indian end users purchase software directly from the non-resident software service providers, distributors, which means that wholly owned subsidiaries of large multinational enterprises were distributing the software. Similarly, sub-distributor arrangements. And the last category was where software is embedded in the hardware itself. Next slide, please. The court then went into the vexed issue of royalty, but in its endeavor, it went into the definition of the term copyright and whether it is indeed a copyright or a copyrighted article. The copyright being the creator or the author of the literary work, inclusive of the computer program, which has the exclusive right to do or authorized to doing of several acts in respect of the work. This is really the definition under the Indian Copyright Act. And then the implied definition of what is a copyrighted article, for which the court had given an interpretation, though in the context of Copyright Act, where it says where a physical program is embedded in a software which is subject to copyright, the entire physical program, if sold for a fee, comes within the definition of the copyrighted article. And thereafter, the court went into the determination whether this would be royalty, taking into consideration the OECD commentary, and how does it pan out in the context of retrospective amendment. The court, for illustrative purposes, picked up the definition of the term royalty in the Model Convention. It read the definition in the Model Convention along with the commentaries, and it came to a view that the commentaries assume significance and have persuasive value for interpretation of the term royalty. This is not the first time that the federal court was taking a view. Federal court had taken this view in the past as well, though not as directly as it took in the context of the term royalty. With regard to retrospective amendments, the court said undoubtedly, tax being a sovereign subject within the constitutional framework of India, the parliament has the sovereign rights. However, we should recognize that the 2012 amendment, which is being brought in by the Union of India and the law officer as an argument to tax royalties, is based on a retrospective amendment. And the code posed very important question. Could the lawmakers have thought of the definition of the term computer software way back in 1976? What about the technological developments that occurred in India and around the world in 1990? And it actually labeled the argument of the Union of India as ridiculous that you can go back into the definition by over 50 years. It also then came out with the doctrine of impossibility and said the doctrine of impossibility directs that you cannot impose such forms of consequences which are harsh in nature, that too under a retrospective law. You're essentially saying that somebody ought to have had the wisdom of the 2012 retrospective amendment and should have withheld tax for matters which were almost 2 decades old. Next slide, please. when the court came into this decision, it dealt with a whole bunch of jurisprudence. It brought together not just principles articulated under the excise law, VAT law, customs law, and for the sake of argument, I put all of that as tax laws, but it went into the international public law. First, Vienna Convention. Under the Vienna Convention of the Law of Treaties, which we all are familiar with, Article 31, Article 32 was analyzed by the court. And the court, in its pursuit to analyze, made wide references to how the Australian Federal Court and the UK Supreme Court has analyzed the Vienna Convention, which indicated the desire of the Indian Federal Court to analyze international cases. All of these cases are mentioned in the annexure to the case, to this presentation, so I'm not going to get into that. But for an avid reader and a researcher, you may want to look at it. Second was India's reservation to the OECD commentary. Well, historically, India, despite having the 1980 UN Convention, which it says is following for treaty negotiation purposes, uses a blend of the UN and the OECD Model Convention for negotiations of treaty. And hence, it had always expressed reservation amongst various reservations. One of this was in the context of the definition of the term royalty, wherein India expressed a view that the domestic law, which is a far more tightly worded definition, is something that will prevail. It did not specifically say that it will override the treaty, but nevertheless, those reservations of India were very much there on record. Finally, the court dwelt into details on the doctrine of first sale in the context of copyright law, where it says that it clearly distinguishes a copyright from a copyrighted article, and a copyright owner essentially exhausts all rights on the copies of the software upon making the first sale, of course, with a rider that there is no indication of subsequent commercial exploitation of such copyrights. So these were the three important principles that the court did dwell upon while coming to the conclusion. Next slide, please. I'm not going to spend a whole lot of slide, but I think this debate would be incomplete to point out what were the various arguments that were advanced by the law officer in India to support its case. And clearly, what stood out very clearly was heavy reliance by the Union of India or the law officer in saying what is put out as India's position on policy front, whether it's got to do with picking up certain paragraphs from the 1999 e-commerce committee report or the 2016 e-commerce report, which was immediately after action point 1. In both these reports, the view of the policymakers was very clear, a strict source-based principle. And the court had a very easy way to negate the arguments by saying, within the constitutional framework, the independence of the judiciary is paramount. They are supposed to be interpreting the law, keeping in mind not just the domestic law, but the international customary law. The views that are expressed by the policymakers are merely their views. They do not bind the court, particularly the final court, which is looking at the interpretation of the law, and all the other arguments were negated. The Union of India made wide reference to international cases as well, particularly the Autodesk judgment. I made references of that in this presentation as well for you to review, but I'm not going to labor anything more than that. Moving ahead, next slide, please. What are the key takeaways? Well, the key takeaways clearly is the importance of the treaty law over the domestic law, which has come up for reaffirmation many, many times before the federal court, but certainly the second most important time, and the first being in Azadi Bachao Andolan case, when the issue before the federal court was the primacy of the India-Mauritius Treaty. Interestingly, in the Azadi Bachao Andolan case, it was the Union of India which was trying to support the treaty because it was a public interest litigation. Nevertheless, in the software case, the whole principle was re-emphasized upon. Second, the desire of the Union of India to override a treaty obligation was viewed clearly by the court and frowned upon as being unilateral in nature, and hence the court overruled it. More importantly, as I had mentioned, the importance of OECD commentary, despite the observations made by the Indian policymakers on the OECD Model Convention over a period of time. Emphasizing on the importance of Vienna Convention, despite India not being a signatory to the Vienna Convention, clearly, this did not happen for the first time. It happened in the famous Ram Jethmalani case, which was debated, interestingly, in the 2012 Paris Congress as well. Finally, on the last slide, which essentially deals with the question of taxability of embedded supplies, which is really the fact pattern 4 that I mentioned. The court had an opportunity to dwell upon contemporary business models and how business models have evolved over the years, and hence you cannot debundle the hardware and the software part. Some of these observations are very, very interesting, and I know my friend Peter Barnes want to comment on that, so I'm not going to take away the thrill from that. But with that, over to you, Johan, to take us through this debate. Thank you very much.
Thank you very much, Mukesh. Thank you, Robert, for the invitation. Good afternoon from Cape Town to all IFA members. I'm going to make 3 points in 3 minutes. Please bear with me if I oversimplify. The first point is going to deal with the facts. Secondly, domestic law. And then thirdly, I am going to say something about whether I think there's lessons here to be drawn for others. So the facts, ladies and gentlemen, all I can say is res ipsa logitur. The facts speak for themselves. To me, it's very straightforward, the facts. These payments that were subjected to withholding tax were not for any brain work in India. And by brain work, I mean the exercise of wits and labor to develop or to adapt the intellectual property that's being protected. So what the end users were paying for were essentially copyrighted products, and the resellers were just trading in these products. And it's much like buying a book in a bookstore. You're buying a copyrighted product, and the reseller, the bookstore owner, purchases and sells these products. So why then this almighty series of disputes about whether what to me seems in the ordinary sense is clearly not a royalty, whether all these disputes arises in India? The reason, and that brings me to my second point, I think it's mainly got to do with how Indian domestic law is set up. So as we've heard from Mukesh, since 1976 to 2012, the Indian government has introduced a series of what I call deeming rules. They legislated legislation, the effect of which was basically twofold. Firstly, the general legal and commercial understanding of a royalty was expanded to include payments that in the general sense is not a royalty. And then secondly, the judicial understanding of nexus for intellectual property related payments developed in 1977 by the Indian Supreme Court, the so-called business connection test, was overridden by deeming legislation. And that is the familiar rule we have in the models to focus on the residence of the debtor, to fix a source and nexus at where that person resides. So it's interesting, the documents before the Indian Supreme Court could not explain, or I could not pick up from them, a tax policy or economic policy rationale for all this deeming legislation. All that appeared to be going on here was collection of taxes on non-residents. That seems to have been the motivation of the Indian government. So the Supreme Court essentially identified 3 layers of meaning: general domestic law, domestic tax law, and treaty law. And the general law and the treaty law meanings coincided, and you had this intermediate layer of deeming rules in domestic tax law, for which there was an absence of a rational tax policy justification. And I think that ultimately was fatal to the Indian government, which brings me to my third point, lessons for others. I think lessons, especially for developing countries, you have, if there's an absence of a coherent domestic tax policy behind legislation, a government is going to run into problems in a cross-border context when tax treaties are in place based on the OECD model. These disputes can be avoided if there is clarity about nexus. That seems to be a recurring theme in India. What it practically means is more precise sourcing rules. And in this regard, I think it's extremely welcome that the blueprint exercise around Pillar 1 is trying to develop more precise sourcing rules. I sincerely hope there will be consensus around those rules because they will bring much clarity. The consequence of that will be that governments will also have to rethink their other sourcing rules for payments related to digitized economic activity. My last point, and then I finish. The use of retrospective legislation in India is very notable. I think in other countries, my own, it will raise a host of rule of law and taxpayer rights questions. It's very peripherally dealt with by the Supreme Court, and I think that aspect certainly is one that in other countries will perhaps attract more attention. Thank you very much, and I'm handing over to Sophie.
Thank you. I just have a brief comments we, of course, at the OECD followed with great interest the Supreme Court cases of India on the computer software, and we welcome the decision that is in accordance with the OECD commentary on Article 12, such as paragraph 12.2. But taking a step back a little bit from the technical issues, I think what is very significant in the decision of the Supreme Court of India, that it's confirmed that when two parties use the language of a model, whether it is the OECD or the UN, they use the language. Well, the treaty negotiator around the world are putting a lot of effort into building commentary to help having a common interpretation of the term they use during their negotiation. And so what is important is when they use that language that the court and the taxpayer can rely on the common understanding of the term used under a tax treaty. So in that, it is really welcoming, because without that common understanding of the meaning of a term, then you create tax dispute on the application of the treaty and double taxation that will follow from those disputes. The two things that treaty are exactly trying to address. On technical points, India had made some position on some of the commentary, but not, maybe I'm mistaken, but not specifically on the 12.2. So I think it's in line too with the way observation and reservation would apply for members, or position would apply also for non-OECD members. So on that, I will turn to the next member on our panel.
Yes, I think it's a perfect time to turn to Jonathan for an input generally on a common theme in international tax law, the use of reservations and relevance in tax treaty interpretation in particular.
So, hi everybody, thanks very much, and thanks both to Sophie and Robert for that introduction, because this did strike me as one of the very interesting issues in this case, because there are very few cases around the world where the status of reservations and observations have been considered. So we saw it, for example, in the Canadian Federal Court of Appeal in the Prévost Carr case, where the court there said that the fact that both contracting states had not entered observations on the commentary was a factor in deciding whether to use later commentary in interpreting a treaty. In the Fowler case in the UK, one of the distinctions that I actually sought to draw there was between the position of an OECD member state and a non-OECD member on the question as to whether they had expressed any sort of view at all about the commentary in particular. Circumstances seem to me to be quite different. I think the Indian Supreme Court's treatment of the question in this case was interesting, mostly from the point of view that they raised it, but I'm not sure whether the analysis is entirely correct. As Sophie says, firstly, the positions taken by India did not really address the point that was exactly in issue. So perhaps one might regard these as obiter dicta in any event. But I think what is also really quite important, and that is that the commentary itself uses the word position for both categories of reservations on the article itself and on observations on the commentary. And I think that they are quite different and have a very different function. And that was definitely not teased out, but I think is a very interesting issue. So reservations on the article, certainly in line with what the court was saying, the fact that you say that you reserve the right to take a different approach in your own treaties doesn't actually change the interpretation of the treaty that you actually conclude. It's just setting out your negotiating position. Whether that ends up in a treaty or not is just a question of what the parties ultimately agree. Observations on the commentary, which is saying whether you dissent in whole or in part with portions of the commentary, it's slightly different. And I think this is a very, very difficult issue because it's rather similar to the issue that we see under the Vienna Convention in relation to reservations on treaties. And that is itself a very difficult and complex issue. And the fact that the court said that one should disregard those seems to me to be something that one should actually be quite cautious about, because if a country dissents from a view, why is it that you would say that actually the commentary should be followed? And I think that that actually turns on a completely different issue, which was not discussed by the court. It said that the commentary is of persuasive value, but the question is, when is it persuasive? And the UK Supreme Court, again in the Fowler case, has said there's only one real test, and that is the cogency of the reasoning. In other words, in line with what the Canadian Federal Court of Appeal said in the Prevost Carr case, is it consistent with the ordinary meaning of terms and the ordinary interpretation that is arrived at by applying the principles of interpretation? And I think any other approach, simply saying, well, we disregard it, is actually a sideways way of saying, well, actually, the status of the commentary as a whole is something that we're also perfectly entitled to disregard. I think this is an important area because we're seeing the use of the commentary, and particular later commentary, more and more often in cases around the world, particularly in situations where courts have previously been reluctant to use the commentary. So this is an area that I think calls for some very careful analysis, thinking about the exact role of the commentary. If you look at paragraph 3 to the commentary, or the introduction, which the court actually cited, although they didn't underline the interesting bits as far as I'm concerned, the commentary is directed towards the tax administrations to follow the commentary in order to avoid disputes. It's not a direction to anybody else at all. And so that is also consistent with the fact that it is tax officials who write the OECD commentary. So an independent judgment must be made about the value of what is said. And I think in that context, you have to take seriously the position that both OECD and non-OECD members take, that they do express about the use of the commentary in particular circumstances. And with that, I'd like to hand over to the next contributor, unless I'm usurping Robert's
No, absolutely. You're not reserving, and I would be pleased if you do so, Jonathan. Just a small point to tell you that we are a bit late in schedule as I had anticipated, but not to frustrate anyone from opining on any of the other points. Yes, so the next speaker will be Adolfo. I think you have a remark on the 92 commentaries.
Well, thanks, many thanks for the invitation. It's a pleasure to be here, also in my personal and institutional capacity. I have 2 comments on the judgment. First, on its coherence with international tax policy in India, and second, on the interpretation of the OECD model. Well, actually, originally, Article 12 was included in the model as a carve-out to the permanent establishment principle to permit source countries to tax companies doing business letting material and immaterial property within their territory, and for an activity in which they did not really need a fixed place of business or a dependent agent. So when Article 12 and the commentaries were modified in 92 to exclude from the royalty concept income derived from the use of equipment and software, this implied a radical twist in the function of Article 12. And the majority of states making reservations on that article after 92 wanted to actually point at that specific twist. And that's the function of the reservation that India made in 2008. So from that angle and from that perspective, I see the Supreme Court decision as a sort of policy choice, dismantling India international tax policy over the years on the taxation of business profits. Is that something that the court should do? I don't know. I leave that for discussion. If we take the perspective of the OECD commentaries, the Supreme Court is claiming that it is speaking an international tax language. But behind that parlance, there is an inconsistent interpretation, in my modest opinion, of the software commentaries. The commentaries of 1092 propose, as Sophie has pointed out, an autonomous meaning of the terms use and indirectly sale in Article 12. If the only right granted to the user is the personal copy without any permission to exploit the software, well, this is not use. This is sale. There's no need to refer to the source country legislation. That's autonomous in the commentary on Article 12. So all the reasoning surrounding the Indian source country legislation, if we take the commentaries after 92, to me, is completely irrelevant because we have an autonomous meaning of the term used there. So from those angles, as an outsider, I'm not sure whether the decision is correct. I can understand how happy advisors and companies may be with the decision, but even for them, I'm not sure it is a right one in terms of certainty and predictability. And those are my comments. Thank you.
Thank you very much, Peter. I think you're on mute, Peter.
That's pretty bad. Apologies, Robert. Thank you. As Mukesh pointed out, category 4 of the cases involved embedded software, where the software was integrated with hardware and the hardware was sold to customers. In this case, the taxpayers won. I find this a fascinating area, and I think there's going to be a great deal of litigation going forward. As we all know, the instruments that are sold today, machines that are sold today, all have software in them, from a $5 thermometer to a $5 million aircraft engine to a $500 million power plant. And in each case, the question is whether the software is separately identifiable, should be taxed and treated as separate from the hardware with which it's integrated. I don't think the decision here, which is that the taxpayer won because the software was integrated with the hardware, will be respected in other cases with other facts. It's going to turn on a variety of things. Is the software sold separately? Is the software updated on a regular basis? Can the software be removed from the hardware and transferred to other hardware? I just want to flag that I think the question of embedded software is going to be a major question for our time as we go forward, because many courts are going to want to, many courts and tax administrations are going to want to view the intellectual property embedded in hardware as a separate item for which royalty treatment applies. And I think taxpayers need to stop and think about how they are treating that software. In many cases, the taxpayer, I think, needs to identify in advance and be prepared for challenges by thinking how to value the software, whether there are updates, whether the software is sold separately. So I just see this as a burgeoning area for future tax litigation. Thanks, Robert.
Thank you very much, Peter. Yes, I will refrain from commenting on the case, which raises significant issues because we are a bit late on schedule. But I think perhaps once we reach the end of the session, perhaps we may have questions from the audience that we can turn back and then revert to this case. But in the interest of time, I think it's it's appropriate to move to the next panel. The next panel is, as I said in the introduction, is about three important transfer pricing case. We have three sets of presenters for each of the cases, and we have the same panel. So I will introduce everyone in a row. So the first case is going to be the Glencore case in Australia. There we have the pleasure of welcoming Neil Tadmore, who is a partner at Jones Day Global Tax Practice in Melbourne. And he's also the chair of the Global Supervisory Board of IFA. He will be joined by Benjamin Lancaster, who is of counsel at the same firm. Then we will move to the Coca-Cola decision, which will be presented by Clark Armitage, who is a transfer pricing advisor and a member at Kaplan and Drysdale in the US. And then we will move to Cameco and Agracity. And there we have the pleasure of welcoming Al Medji, who is a partner and the head of the tax controversy practice at Osler in Canada. The panel, as I said, the panel population will be the same for the free decision, but not everyone will be making inputs on every decision. So again, in alphabetic order, Matt Andrew, who is the head of the tax treaty transfer pricing and financial transaction division at the OECD. He will be giving a wrap up at the end of the presentation of the cases. Vikram Chan, who is a professor of law at the University of Lausanne in Switzerland. Guglielmo Maisto, founding partner Maisto and Associati, and a professor at the Università Cattolica di Piacenza, I hope I pronounce well. Luis Schweri, who is a full professor of tax law at the University of Sao Paulo and a founding partner of Lagas, Martins, Pereda, Neto, Gurevich, and Schweri, Advocados in Brazil. And finally, Isabel Verlingen, who is heading the Pricewaterhouse global transfer pricing practice. So you see, well-known speakers, well-known IFA friends. So I think with that, we'll turn to you, Niv and Benjamin, for a presentation of the Glencore case.
Thanks, Robert. So the Glencore case is the most important transfer pricing case in Australia. It was decided by our full federal court last year. It is about our old law, but it does talk about something that is very important to transfer pricing. It focuses on the arm's length principle. And that's why it's important to our new law, relevant to our new law, and public globally as well. And that's a key focus of the case. It has two other important aspects in terms of transfer pricing. Is what can you price? So what are you looking at when you talk transfer pricing? It's only pricing or something beyond pricing. It doesn't like the CAPS method. And also it gives some interesting commentary on the OECD transfer pricing guidelines. Now, the tax office lost this case and they sought special leave to the High Court. Today is the 21st of May in Australia. It's already after midnight now. So today our highest court will decide whether or not to take on this appeal. In 18 hours, we will know the answer. What I will do, I will hand over to Ben to give us, to set out the background of the case and the findings of the case.
Thanks, Nip. So in terms of giving an overview of the facts of the case, we really wanted to simplify it down to what are the things that were critical to the court's decision here. And here we think there's three things you probably need to know. The first is that we're dealing with an Australian copper miner who had a long-term offtake agreement in place with a Swiss-related party that covered absolutely all of its production. Now, that agreement picked out a pricing method that was used in some contracts seen in the market, and it also included some rights for the Swiss party to terminate the agreement by giving certain notices. Now, that agreement was varied in 2007, predominantly for the purpose of changing the pricing mechanism in that agreement. And the new agreement, which picked up a pricing method that was seen in some third-party contracts, though perhaps not in quite the same form, reduced the taxpayer's exposure to the risks of some of its costs escalating. And these were costs that might have moved differently to the value of the commodities it was producing, so may well have impacted the viability of the mine. Now, the key issue here from the tax authority's perspective is that the agreement was forecast to, and it did, reduce the profitability of the Australian entity. And that led the tax authority to unsurprisingly dispute the transaction, and it issued amended assessments for the 2007 through 2009 years. And if we could have the next slide, please. I just want to reflect there on that, giving an idea of how long it may well take for a matter to work its way through the Australian system. So when it came to the arguments of the parties, the tax authority's case had a really charming simplicity to it. They simply argued that an independent party would not or should not have entered into the variation of the agreement, and therefore the arm's length conditions were simply the terms of the previous related party agreement that existed, which obviously included a different pricing mechanism. Now, the court was very, very clear that that is the wrong approach to transfer pricing, at least in Australia, and that the idea was really that the old agreement between the parties says absolutely nothing about whether their new agreement was arm's length or not. But the court did accept parts of the tax authority's arguments there, and in particular accepted the notion that you can change the pricing mechanism of an agreement. But this came with a really, really big but. And that but is that there's an arm's length range of pricing structures, not just an arm's length range of prices as is commonly spoken about. And arm's length parties, the court recognised, may well adopt a range of different pricing mechanisms that take into account a range of different factors to come up with prices that could have wildly different bases. So the court then had to consider, well, was this agreement one that arm's length parties might reasonably be expected to have entered into? And it said yes. It weighed up all the evidence that was before it in the case, and that evidence included not just contracts said to be comparable, but also an expert in the copper mining industry that the taxpayer had put forward, and a number of publications from a sort of market pricing reporting service. Here it was Brook Hunt. Now, there was a lot of argument in the case about whether the contracts that the taxpayer were trying to rely on were comparable in the OECD guideline sense. And the court's approach to that argument was simply to say, it's not quite answering the right question. You know, even if a comparable doesn't pass the OECD guidance standard, it can still be a really useful reference point or an example of what other parties may well have agreed in their circumstances. And it's still something that's open to the taxpayer to use in trying to prove their case. So the court, in accepting the taxpayer's position, essentially wholly rejected the tax authority's argument and found in favour of the taxpayer, other than for a very peripheral issue that we won't get into today around shipping terms. If we could go to the next slide, please, and I'll hand back to Nib now, but I do want to highlight Nib's comment that we'll know more in 12 to 18 hours once we hear whether our highest court will take the case, and obviously we'll be posting updates on that result. So stay tuned. But with that, I'll hand over.
Thanks, Ben. So the impact on the legal landscape has been quite significant. So the first point to note, as I mentioned earlier, and as Ben mentioned, although it was the old law, it is about the arm's length principle. And that's a very important point, because what the court said and what the court focused on is, if you look at the third bullet point, commercial rationality. Because our tax authority here has tried for a long time to argue, and I'm borrowing David Rosenblum's favorite term, it's if it doesn't happen in the wild, you cannot defend it. It's a unicorn. And as you know, a lot of transactions you do not see in the wild. You do not see equivalent transactions in the wild. You do not see in the pharma industry, in the tech industry, you simply do not see similar transactions. Our Chevron case that was before such a big loan did not happen in the wild. So what the commercial rationality argument says is basically, if it's commercially rational to do it this way, it's fine. You have a safety zone. If you can define the commercial rationality, you're fine, even if you don't see similar transaction elsewhere. Now, the point is, in Australia at least, is that it's up to you, the taxpayer, to prove that what you did was commercially rational. And the way in this case, it was proven, it was basically, you need an industry expert. So what happened here, basically what the company argued, is very simple. We didn't want to take that risk. We wanted to lower the risk. We didn't like how the market was going to look like. And the experts said, yes, in this industry, it's rational not to take such a high risk. It's rational to take a lower risk. And that was basically the end of the story. So what the court said, you open the door. You don't only look at caps and what's in and what's out, and all of this technical, mechanical analysis of contracts. You actually can go in to see what the commercial animal will think about. Its risk, it could be maybe climate change, it could be a lot of other factors that could fit into that question, is it commercially rational to do so? And that's a big change. Now, as you all know, if you dealt with transfer pricing, that's a big change, especially if you think about the cap method. Now, the other point is that our revenue authority, our tax office, has not accepted that decision. That's why they took it to the High Court. And they have not been willing to deal with it at this point. And tomorrow we'll know what's going to happen there. Because you can imagine from a tax administration point of view, it's much more difficult to look at these fuzzy, vague terms of commercially rational and take into account all of these commercial decisions and what comes into play. Much easier for a revenue authority to take the cap method and apply it mechanically or not, but it's a much easier way for them to deal with the transfer pricing issues. So what the implication in Australia, at least, is that it requires a much more sophisticated consideration of what are the arm's length conditions. It can, as mentioned, it can be beyond just price and profit. In this case, it was the pricing structure of the agreement. So it's not only the price, but what leads to the price. And the court gave a number of ways how do you define which terms of the agreement actually end up in affecting the price, and it's not a clear-cut test. An interesting point the court made is that when you look at what is commercially rational, when you look at the transfer pricing issues, you are looking at, you depersonalize the taxpayer. So if that particular taxpayer had global policies that were designed to deal with related parties, the court said that's not on. I cannot take that into account because those policies by their very nature are not arm's length. So I need to look beyond that. I need to look at an objective commercial animal and how that animal would behave in the wild. And as we mentioned, as Ben mentioned before, the important expert in this case was not the economist. It was the industry expert who could tell the court, in this industry, that's how you would behave. That's how you would make decisions about your agreements. and it also means that it's harder for the ATO, our tax authority here, to attack restructures using the transfer pricing rules. And the ATO have been trying here. In Australia, when you get to a large transfer pricing dispute, it's not about the pricing, it's about the transaction. The ATO almost always start with attacking the transaction if it's a big dispute, rather than the pricing. And that has slowed down the ATO a bit because, and that's why the ATO took it to our highest court. I just add to that, that because we have a very aggressive or very broad GAR in Australia, what we're seeing now is that the ATO are using GAR with transfer pricing together in order to restructure, recharacterize the transaction. So this is the impact in Australia. And if you move to the next slide, please. Let's see what does it mean to the global landscape if the decision remains on foot after tomorrow. The first thing is the OECD, the interpretation of the exceptional circumstances. Again, you do not need only to look at the price, you can look at the structure, the pricing structure, and what ends up, what leads to a price. And that could be quite important. The more important point, I think, is what our court said about the OECD guidelines. The OECD guidelines, and if you look at that bullet point, the court was not sort of a big fan of the OECD guidelines. You can see that. Very highly generalized, frustratingly opaque, and lacking the much greater discipline and rigor in drafting that is usually found in domestic legislation. So basically the court said that the OECD guidelines are a bit vague, they're a bit gray, they're not determinative, it's hard to work with them, and that's why the court did not give too much weight in that case to the OECD guidelines. Ironically, our new legislation is incorporating the OECD guidelines for the legislation, so it's going to be interesting to see what happens in future cases. But leaving that aside, the OECD was pretty scathing about the OECD guidelines. And I think the last point is that the OECD guidelines, and I mentioned the CAP method before, they focus really on pricing. That's the real focus. Here, you have basically the court opening the whole thing, opening the whole commercial thinking. And that's why the court said that you can have more than one price, because you can have different appetites to risk. You can have different commercial consideration that ultimately will result in different pricing. And that's opening a very big spectrum for transfer pricing. And how do you prove about it? How do you go about actually proving those things if you're a taxpayer? It could, if that principle is adopted elsewhere, it could, of course, increase disputes between, or disagreements in MAP between revenue authorities, because more, if you're broadening the broad of the inquiry to commercial considerations, you get more uncertainty. And when you have more uncertainty, you get more disputes. So that could be quite an important impact of that. And the big question is whether other jurisdiction will follow that code guidance. Anything else, Ben?
No, I think that's a really good summary.
So this is, Robert, our summary of the Glencore case for now.
Thank you very much, Niv and Benjamin. Thank you very much. I think in the interest of time, I will ask Guillermo, Luis, and Isabel, perhaps successively, for a quick reaction on the case. So perhaps to begin with Guillermo.
Thank you, Robert. I think that the comment I have is very short. I think the decision explains how important is to monitor case law. That is becoming crucial, comparative tax case law, because indeed, and I think we can go to the slide which I have prepared. I think that case was based on the guidelines prior to the 2010, I think the 1995 guidelines, because of the taxable years covered. And I believe because of the Glencore decision, I think the 2017 guidelines have changed the language. You can see here the move from the 95 2010 guidelines referring to substance over form as a possibility to recharacterize a transaction under the transfer pricing rules to the new language of accurate delineation, which I think is probably driven by decisions like Glencore, because as HMRC in the UK indicated in commenting the 2017 language on accurate delineation, it says that is driven, the 2017 change of the guidelines, to the fact that domestic law in some countries does bind the tax authorities to establish the transfer price of a transaction based on the contractual form rather than substance. And that is not something that you find in many civil law countries. So I think it's the case is very important for showing how the guidelines are evolving, taking into account case law of some jurisdictions. So that is my comment. I think Louis is coming after me with some other comments.
Yes, Luis.
Thank you, Robert. Thank you, Guillermo. Thank you for inviting me to here and to offer me the opportunity of knowing the case Glencore. I did admire very much. I would just call attention to the idea that in this case you learn or you relearn that arm's length is much more than pricing, it's also conditions. And so to say that you must first see whether the conditions are arm's length. And once you test the conditions, then you test the price according to the conditions first established. I like this two-step analysis which was made, because usually you begin directly with the pricing and depth in the pricing, but first see whether the conditions are or not at arm's length. Another point which I found interesting here was to see that there were two experts presenting their analysis on the prices, and the court says, well, both of them are correct. So to say that the fact that the tax authorities may have a good analysis is not enough for one to dismiss the analysis made by the taxpayer. So they should first say that the analysis made by the expert of the taxpayer was not correct, and this was not done. So the idea of range was also important in the case and should be mentioned here from the case. So the range idea, and also the question of the importance of the commentaries should at least be mentioned, that it was pointed as vague, but looking at the case itself, it didn't seem to contradict the guidelines, concretely speaking, because when you see the guidelines by itself, it says that first that you would have to test whether the arrangements differed from those which would have been adopted by independent enterprises behaving in a commercially rational manner. So this test was already in the guidelines in 1995, and this was what was done there. So, and it seems very reasonable to say that one company doesn't want to run risks. So, summarizing, what's important here is to say that when you make a transfer pricing analysis, you must depart from the freedom of the parties to decide which risks they want to run, and then you make the analysis. You may not force them to run risks which they don't want to. So this freedom seemed to be an important point in the case. Thank you, Robert. Isabelle is the next one.
Thank you. Yes, Isabelle, please.
Thank you, Robert. Thank you, Louis. Last time, I think I was on a panel with you, Louis, in a hotel at the beach in Rio, rather than being grounded at home. Anyway, I have three short things to say about this case. First is on the comment made by Ben on the reference points, and the second is on risk, the risk control framework, and the third one is on transfer pricing and avoidance. So the first point, reference points, this was pretty interesting in a sense that the taxpayers seem to have an interest in showing evidence that their position is within a range of commercially acceptable arm's length outcomes. And this is one of the few instances where the current pandemic offers an opportunity, I think, for us. What I mean by that is, together with our team led by Diego Muro, we made a whole inventory of third-party behavior, third-party contracts, and how the pandemic is affecting those relationships between third parties. So I'm trying to take this case and look through it from a current lens. So you see franchising agreements being revisited, you see real estate contracts being revisited, financial services contracts being revisited, and this may all be relevant when dealing with tax authorities on a day-by-day basis, because there are more cases you agree on with reasonable tax inspectors than cases that eventually end up before court. So when I take a dynamic interpretation of the OECD guidelines, you see that at face value, it may become more difficult to get things through the comparability sieve on the one hand, but on the other hand, taking these sort of imperfect comparables, third-party references, and bring them in the equation is something for which this case can give inspiration. The second one on risk, well, interesting in the verdict is that taxpayers are not required to maximize profitability at the expense of risk mitigation. That's an interesting one, because indeed, since 2010, the OECD guidelines are clear that tax payers are authorized to diversify entrepreneurial risk over the various affiliates, and that doesn't affect the goal congruence for the multinational as a whole. So you can still do that within the arm's length principle. I have, though, a small remark and maybe a little point of criticism, and I'm sure Matt is going to deal with that later on. That's the risk control framework. I think Professor Maisto was already making a reference to it. When you look at risk management and when I read the guidelines, so the decision to take on or to reject, decline a risk-bearing opportunity needs to be with a party that is part of the contract. The decision on whether and how to respond to the risk associated with the opportunity to the risk associated with it, that's something that also should sit with that party. On the other hand, risk mitigation or measures that affect risk outcomes can sit with somebody else. That's really tough in practice to interpret every now and then. You have sometimes very pivotal decisions, like we're going to enter a market, we're going to exit a market. These decisions are high consequence, and they can have a range of derivative decisions that are still important. But the question is, do we need to make an assessment, a distinction based on the sort of high or low consequence? There's a lot of uncertainty and maybe room for controversy on that one. Third and last point is on transfer pricing and anti-avoidance. I think if I read the history of transfer pricing well, the original intent of transfer pricing legislation was anti-avoidance. In the absence of unitary taxation, it seems as if we're back in that sort of era. What I mean by that is you see a lot of references to transfer pricing and anti-avoidance. And as a Belgian and as a person based in Brussels, I would like to grab the occasion to quickly refer to the launch of the EU plan last Tuesday, I think, this week on Tuesday, where you see that the business in Europe tax framework talks about a revision of the ATAT. It talks about ATAT 3 on weekly capitalized, on companies with weak substance. It talks about changes in the interest and royalty directive. When I bring all that together, it seems as if last year battles are still at the forefront of things, because the question is whether we need all that We had BEPS. We understand how economic substance need to be dealt with. So the OECD rules on non-recognition are clear, but we do see a surging number of allegations in that direction. And again, being an EU citizen, the whole directive on DAC 6, for instance, mandatory the mandatory disclosure of so-called aggressive tax planning, things on business restructurings, hard to value intangibles, and so on, are not helping the case. It gives very quickly the indication that you're doing something in the direction of trying to avoid tax. So this sort of viral spread of anti-avoidance measures, including CFC rules, are somewhat scary and frightening. And the question is, are companies really disguising real activity leading to economic inefficiency? So, and at the end of the day, the principal purpose test under the multilateral instrument is not giving me high hopes on that either. So I see already tax authorities bringing that in, and I think it also ties in to a comment made by NIF earlier, but I'm sure Matt has something to say about that later on. So in a cocoa nutshell, Robert, a few observations, and I think with this we can then hand over to Clark for the Coca-Cola case, isn't it?
Thank you very much, Isabel. No, I think it was more than a few observations. You've just taken us through the entire international tax landscape. So thank you very much. So yes, I think we will move to Clark for the Coca-Cola case. So please, Clark, the floor is yours, and I'm happy to report that we're only 10 minutes late. So This is quite promising.
I can't cut my 15-minute conversation by 10, so I'll do my best to shorten.
No, go ahead.
Thanks, Robert. And hello, everybody. Thanks for joining. Thanks, Peter, for inviting me. I'll get you back later on that. I'm a member at Kaplan and Drysdale, but I've spent 8 years at the IRS APA program in my past, which will become apparent why that's relevant later on. I will say the Coca-Cola case is an outlier from everything else we're talking about today, I think. It's kind of the opposite of the Glencoe decision. And thanks, Niv, for your comments about Into the Wild with David Rosenblum. I think things seem to be getting wilder outside the United States, but tamer in the United States. And I think that's kind of what the Coke decision is all about. Just in a nutshell, the IRS won, and they won big here. The taxpayer wanted to assert that certain related foreign supply points should earn a lot of non-routine profits because they had spent some money on local marketing and extending the brand. And the court handed them a big loss. They sustained something like $7 billion out of $9 billion of adjustments for the 07 to 09 period. The same period as in the Glencoe case, I noticed, which means we're just as inefficient in the US in court decisions as they are in Australia. But I think here the taxpayer faced some really unhelpful facts, and hopefully I'll draw those out and see why this decision ultimately is probably the right decision, perhaps one that laid out some new principles in the US that will be interesting to see how they go forward. But maybe it's a question of just the facts, just this case, but I think it's likely that we're seeing a trend in judicial decisions in favor of the IRS in the US. Luisa, you're on the right slide, thank you. So 4 parties are shown on this slide, and the first 3 are the controlled parties. The last one is unrelated. Those are the independent bottlers, and Coke has bottlers all over the world. They have geographic regions, and Coke sets its pricing to them of services and concentrate and support at a level that is designed to ensure that they split profits in that local market about 50-50 with the independent bottler. And so then the question is, okay, well, how do you split the other 50% between the US and its foreign subsidiaries that are doing business in these international markets? There are the servcos that are mentioned on here those are the companies that are in each jurisdiction. They get about a 7 or 6% cost plus return on sort of what's viewed as a de-risked kind of functionary type of activity. They don't own IP. They're typically in high tax countries. There's 60 or 70 of them. They're located where the products are sold, in the local markets. While they don't get a non-routine profit, they do some pretty important functions. I think Coke would admit this too. They spend a lot on local marketing, advertising, and they liaise with the local bottlers. And those are, critical functions to getting the brand image of Coke out in the correct way. So they're de-risked functionaries, Servcos. Coke US is, I think, what we would think of as the principal in this business. It is the management company. It sets direction for everybody. It owns most of the intangibles, the legally enforceable ones. It owns the brands, the recipes for the various concentrates. It directs the brand. It maintains an overall global brand consistency, and it does manufacturing process changes. It does quality control guidance. So it's really the sort of the brains of the operation. The supply points are kind of the opposite. They have a very narrow function. They produce concentrate based on a recipe and with guidance from the parent. And all they do is produce that concentrate and ship it out to the bottlers and get paid for it. The only other thing they do is they pay marketing expenses. So they, the Servcos, which spend money on local marketing, they reimburse the Servcos. They don't have any direct role in that. They don't have any ability to evaluate whether it's being done well or not. They simply pay them and get and then that has an impact on the pricing here. So they don't really own IP unless it emerges from that marketing spending. Can you move the slide forward? Thanks, Louisa. So about 15 years ago or so, the IRS had audited a number of years of Coca-Cola, and I think it was quite an intense audit. And Coke had a fairly high level of profit maintained in the supply points at that time. And the IRS came in and wanted to lower it. It was magnitudes of difference, and they reached an agreement. And that covered about 10 years from 86 to 95. That agreement is the 10-50-50 method. So the supply points got to keep the first 10% of profits based on gross sales, and then the rest got split between the US and the supply point. I'm not sure we know a lot about the rationale for that, but it looks like it was mostly born of the fact that these supply points did incur these local marketing expenses, and they had sort of goodwill and going concern value that they had inherited from predecessor branches. Originally, Coke had operated through branches, had formed most entities as controlled foreign corporations. So that agreement said, as long as you follow this methodology going forward, Coke, we won't penalize you. And so Coke did just that. For the next 11 years or so, it followed that method, and the IRS looked at it and made no adjustments, 96 to 2006. So we moved to the 2007 to 09 period, and the IRS took a different view. They decided that they didn't think the supply points owned valuable IP, and they decided to put them on something like a CPM or TNMM method. And there was some fits and starts to exactly how they developed that, but the bottom line was that they concluded no non-routine profits belong to the supply points, and they developed a set of comparables based on independent bottlers. So sort of those third-party independent companies that we mentioned at the start, some of those were the comparables used to establish regional ranges for what the supply points should earn around the world. There was a second thing the IRS did there, in addition to putting them on a CPM, which contracted profits by 2/3 or something like that. They also denied foreign tax credits for taxes paid by the Mexican branch, which was the only country where a branch was still in existence. And they denied those credits in part because, first of all, because of the pricing, of course, but second of all, because the taxpayer had not gone to MAP, in their view, to correct that outcome. And so they had lost standing to challenge it. So Coke, in response, said, we think the supply points are risk takers, and we've spent all this money on local marketing expenses and developed immensely valuable marketing intangibles. And, of course, what the IRS said ignored all that. So I think you can tell at this point that it's the marketing expenses is essentially what this case is all about. What value to associate with the supply points expenditures of those amounts. Lisa, could you move to the next slide? Thanks. Okay, so I'm not sure there's really a local landscape and a global landscape. I think everything applies locally and globally in this case. But I split it out based on what I thought would be sort of more intimately local and perhaps more relevant to all of you, what really affects the global landscape. And hopefully I got the right split. The first thing is the court said that we don't agree with Koch, and they said they found, quote, no support for Koch's argument in law, fact, economic theory, or even common sense. So it was a good hard bashing. They talked about, there's several principles that were required to reach that decision. The first one was that the supply points did not have any legal ownership of the IP. Whatever was developed with the marketing expenditures, they did not own. And the court pointed to two ways that legal ownership could be obtained. One is through, having a patent, having a license, having a trademark, et cetera, none of which the supply points had, or having long-term contracts. And they concluded that the supply points did not have long-term contracts. And I thought in a fairly convincing way, a couple of points factored into that. One is that the supply points had contracted from something like 50 different supply points, different entities around the world, to only 7 over about 25 years or so. And the second point was that they had, during the 2007 to 9 period, they'd moved a production line without paying any compensation, which was true of all the moves in the past, by the way, from the Mexican supply point to the Irish supply point. So I think the court took those facts and said, look, there's nothing long-term about the relationship that the supply points have with Koch US. They can't claim that they spent these monies knowing that they would have some ownership of IP going forward. It just wasn't there. I think that later on I'll talk about some counterfactuals, and this is sort of a key area for investigation, I think. I think if there's a lesson from this, it's obviously to paper your arrangements for the long term and then adhere to their terms. So the court then accepted the IRS's CPM outcome, and there's a couple things about this that are surprising. One is that in recent cases, maybe for the last 40 years or so in the US, there's been what I think most people interpreted as a disdain for profits-based methods, including the CPM, the profit split. And I think Judge Lauber in his decision did away with that in one 244-page decision. And it's interesting because Judge Lauber, many of you may remember the Amazon decision a couple of years ago, Judge Lauber authored that as well. And I think we saw in that case the start of a change in how the courts are analyzing transfer pricing case. I think that he brought a different kind of rigor to the transfer pricing analysis. And it paved the way, I think, for the Coca-Cola decision, where he could look at a taxpayer that didn't have a lot of good facts and apply a real change in what had been done in prior court decisions in terms of transfer pricing and profits-based methods. So the court, there was an analysis of the comps. I won't dig too deeply into that. The taxpayer challenged them because they didn't look like the tested parties. They were independent bottlers. They obviously do a lot more than the supply points. The court agreed with that and said, look, the bottlers do so much more. If anything, the IRS selection of them was generous. I think, maybe the transfer pricing folks in the audience just cringed a little bit. You can always have different metrics that are appropriate, but I don't think using something inappropriate is ever sort of more generous, or generally is not more generous. So I'm not sure that that's well-founded, but he ultimately accepted the IRS's comps, and I think that might be sort of a fruitful place for Koch to challenge on appeal. The other thing that the court did is they rejected 3 different analyses presented by the taxpayer. And I have on the slide, hopefully, a point about aggregation versus segregation. And the taxpayer tried to say, look, here's our foreign operation. It's the supply points, it's the bottlers, it's the servcos. If you look at all those together, they do all this really important stuff and have all these risks. And if you just sort of add them together, we got the right profit overseas. The court refused to go down that route. And they said, look, we're only looking at the supply points. If you mispriced or put too little profits in the servcos, that doesn't help you with the supply points. You have to look at, a proper delineation of the transactions, to use the OECD parlance. So I think that maybe that last point is the lesson of this part of the case, is that courts are going to look more narrowly. They're not going to have sort of soft intangibles that they respect. They're going to apply the CPM when you don't have long-term rights. And another aspect of this is they're not going to stretch to use a bad comparable uncontrolled transaction, a cut or a cup, over a decent application of the CPM. They're going to use whatever's best that's in front of them. I think, so I mentioned the foreign tax credit in my opening comments. What's interesting to me here, and I think might be of interest to the audience, is that when a case is designated for litigation by the IRS, that means that you cannot go to MAP. You must go straight to litigation. And the IRS did that here. They designated Coke, and the taxpayer went to the effort of applying for MAP and was rejected. And in light of that, back in 2017, the same court, but in a different decision, held that, IRS, you can't both deny access to MAP and then deny that the taxes are compulsory. You've got to give the taxpayer a chance to meet with Mexico and, sort out that double tax situation in order to deny credits. And so the tax court sustained the credits there. So that was a decent sized win, but small relative to the transfer pricing points. Louisa, could you go to the global landscape? Thanks. Okay, so what's the global landscape? I think the key takeaway for me, and I think there's a lot of debate about this, and I certainly am happy to be wrong. I think the court almost intentionally developed a DEMPI position without ever stating the words OECD or DEMPI anywhere in the opinion. There's some language that I'll quote for you that sounds an awful lot like DEMPI kind of considerations. I do think that probably DEMPI is now part of U.S. law if anyone follows the Coke case as precedent. So how did they talk about it? The court said that Coke US dictated the bottlers to which the supply points concentrate was sold, directed and instructed each supply point where to sell and ship beverage concentrate, controlled how much revenue each supply point received and how much expense each supply point was charged, and initiated intercompany charges that placed on the books of each supply point, as Coke US deemed appropriate, a portion of the Servco's marketing expenses. Coke US similarly controlled the Servco's annual budgets, provided major inputs to their marketing efforts, and supplied final approval for all business plans. And in contrast, the supply points exercised no control over the Servco's marketing expenses they bore. They, quote, played no role in arranging consumer marketing, did not themselves engage in significant marketing activities, had no legal obligation to defray the cost of the Servco's marketing, and in fact had nothing to do with consumer marketing. The tax court found no evidence that supply points received invoices, that they reviewed the propriety of amounts they were charged, or that any supply point had ever explicitly agreed to bear financial responsibility for these charges. Instead, the supply points were passive recipients of charges that Coke US put on their books. I think that sounds a lot like DEMPI to me, all those quotes. And even though the court didn't mention it, I think, one thing that was much discussed in the US over the past few years is it really correct, as I think our BEPS negotiators from the US said, that DEMPI has always been part of US law? Well, if Judge Lauber is right in the Coke decision, then they were correct there. One thing that you might disagree with the judge about if he were applying DEMPI is how he treated the supply points in terms of what they were entitled to because they bore marketing expense. What he implied in the decision that the supply points were really only entitled to a contract manufacturing return, something like 8.5% on their costs. And you have to wonder whether he's inviting the IRS to make that kind of an adjustment going forward. But I think that does ignore any risk even just the expenditures that the supply points made for the local marketing expenses. Something has to be given there, some kind of a risk-adjusted return for whatever that is. And I think that maybe he just didn't get to that point in his decision. It ended up being, it would have been dicta anyway. But that's a point that I think needs to be clarified. So a couple of final points. One is that prior deals don't bind the IRS. In the Coke settlement from the 10-year audit cycle, the closing agreement, it had a provision that said, Coke, you can apply this going forward and we won't penalize you. And the taxpayer said, look, what underlies that is not just that we had a deal, but that it's an arm's length outcome. And that arm's length outcome was, you essentially gave us, the ability to apply that method going forward without ever making an adjustment. You just accepted it sort of indefinitely. And as long as material facts didn't change, we should be able to apply it. And I think there's sort of a fairness element to that resonates with people. I think the court had, I thought, sort of a clever answer to that, which was the fact that the closing agreement actually said you can apply your decision going for the agreement, the 1050-50 agreement going forward without penalty, meant that by saying without penalty, the agreement was implying that adjustments could be made. There just wouldn't be penalties. And that featured in the decision, and that's where the court came out on that. Prior deals don't bind, I think, is the lesson. I said that I was in the APA program and that I make that relevant to this discussion. When I was in the program, we would often have renewals of prior APAs. And one of our starting points in discussion when we felt like we were going to change a TPM was, we're not bound by mistakes we made in the past. We're going to start fresh here and do the right thing in this analysis, in this APA. And I think this is just a similar concept. It doesn't offend me personally. I don't know how others feel about it generally, but it seems to me kind of common sense that if you do require the IRS to be sort of permanently bound, you're just not going to get very good closing agreements going forward. You're going to have to fight every issue. And so it's probably a bad principle to start with. So I wonder if this is a case of bad facts making bad law. And that, bad law is Dempy. I'm not saying it's Dempy, but it's a change in U.S. trends at least. I think the company was a little greedy here. The company as a whole had an ROA of about 55%, and that outperformed something like 97% of comparable parties. But the supply points, the lowest supply point was 94%, nearly twice the company as a whole. And they went up to as high as 215%. Most of those were higher than every single comparable that could be identified. So there was a little greediness going on here. You have to wonder if a little more reasonable, middle of the road kind of thing would have produced a different outcome. I think I was thinking about what facts, if they had been different, would have produced a different outcome. And there's a whole lot of different ways this could have gone very differently. One is that what if the 1050-50 deal that they entered into back in 1996 or so had specified that the supply points were entitled to a profit split because they incurred the marketing expenses? In other words, what if there had been sort of an understanding that was expressed to them that there was, if not a long-term contractual obligation to incur those expenses, some obligation that gave rise to, intangibles. Maybe they could have framed the deal differently and it would have made a difference. Another is just Coke could have actually put the 1050-50 deal in its contracts and said, the supply points have long-term obligations and, full stop. I think they could have also, when they moved from 50 down to 7 supply points, if they had made some payments between those entities in exchange for that sort of transfer of responsibility, that might have helped a lot. Another possibility is that they had a single supply point that then had branches all over the world, and that supply point had a long-term obligation to incur all of the expenditures. They could have, focused the contractual relationship on one entity. So there's so many different ways that the outcomes could have been different in a way that is not all that materially different from the underlying facts, and you have to wonder how such a different outcome would make sense for such a small change. So my last point is just DEMPI is U.S. law. I think it is part of U.S. law now. I think the Koch decision has made that the case. I also think that, you know, there's trends in litigation, you know, and the trend in the U.S. on tax transfer pricing litigation is positive for the IRS and negative for taxpayers. I really think there's sort of a narrowing of what taxpayers are going to be permitted to do going forward. And, you know, there's the Amazon case I mentioned, the Coca-Cola I mentioned, obviously this case. And then there's also Medtronic, which Medtronic was decided at the tax court level a couple years ago, and the taxpayer won. But that was overturned on appeal, and I may have missed where it stands right now, but I believe it's being remanded, and they're having to take a closer look at how they applied the cuts, the comparable uncontrolled transaction there. And, you know, maybe that is also part of the trend. And you look at Judge Lauber's Amazon decision, it's very rigorous, and it sort of sets a new standard for judicial, approach to a transfer pricing case. It's not okay to just put your thumb in the air and make a decision. I think you really have to bring rigor to the analysis. And that's what Judge Lauber brought. I think that's what we're going to see in the US going forward. So those are my comments. I'm going to turn the floor over to Vikram.
Thank you very much, Karl. I think Vikram, yes, has a few comments on the DEMPI functions, and then we'll turn to Jonathan.
Yes, thank you, Professor Dannon and IFA for this kind invitation. To start with, just to pick up on a few points with what the other panelists have also mentioned, I think that the OECD transfer pricing guidelines are sort of soft law, and this soft law is relevant in the interpretation of Article 9 of the OECD Model Tax Convention, or provisions which are similar to Article 9, which are found in domestic tax law of different countries. Now, a question that arises quite often is as to which version of the OECD transfer pricing guidelines can be used to interpret Article 9. For example, if a tax treaty has been concluded between country A and country B in the year 1980, and which has a provision similar to Article 9, can we actually use the 2017 OECD transfer pricing guidelines to interpret this treaty? Well, the answer to that, at least what I think, is that to the extent that the specific provisions or content of the guidelines at stake are clarificatory in nature, then I do think that the changes which represent clarifications can be taken into account to interpret a tax treaty or Article 9. To be more specific, the question that I would just like to address in my input statements here are whether the concepts such as control over risk or financial capacity to bear risk, which you find in Chapter 1 of the transfer pricing guidelines, and the concept of DEMPI, which you find in Chapter 6, are these concepts clarificatory concepts, or whether they are something new? Well, if you say they are clarificatory in nature, then we can definitely use them to interpret Article 9 for older treaties too. Whereas if they are considered to be substantial modifications, then they cannot really be taken into the interpretation process. In a paper that we've written and which was published in the IBFD, we've mapped the OECD transfer pricing guidelines from the year 1978, as well as the US Treasury regulations from the year 1992. And basically, our analysis shows that these concepts are clarificatory in nature, and they're not substantial modifications as such. So now, if I just turn to the Coca-Cola case, the question from an accurate delineation standpoint, to just summarize the entire big issue at stake here, was who bore the key marketing risk and who owned the marketing intangibles in the Coca-Cola case. Now, the taxpayer here argued that in one way or another, because the marketing costs were borne by the supply points, the supply points should be the owners of the marketing intangibles. Now, however, many supply points did not, at least my understanding and reading of the case is that many supply points did not have marketing personnel who could actually control the key risks or carry out the DEMPI activities associated with the marketing intangibles, although, as our presenter has mentioned, they had the financial capacity to bear the marketing risk in the sense that they could, bear the expenditure, or they had the cash to make the expenditure for the marketing risks. Now, in the US terminology, the supply points did not have the appropriate economic substance in relation to the marketing intangibles. Now, as there were no employees within the supply points who could control the key marketing risks associated with the marketing intangibles, the US tax code basically has decided in favor of the tax administration. And I think that what they have done is absolutely right. And this also coincides with the work of the OECD on control over risk, financial capacity to bear risk, as well as the DEMPI concept. On the other hand, with respect to the commercial irrationality exception, which you find in the OECD transfer pricing guidelines right now, to which we've already spoken about in the Glencore case, and which will be a point of discussion in the next presentation, I have my reservations. And I think this insertion in the OECD TP guidelines of this test, first in 1994, and then its modifications in 2017, does create a lot of problems with respect to recharacterization of transactions. If you don't mind, I will come back to this test after the presentation on the other Canadian cases. Back to you, Professor.
Thank you very much, Vikram. I think we have Jonathan.
So I have 3 points. The first point is that I disagree with both Clark and Vikram. But you'll be happy to know that we don't have enough time to go into that into detail. We have to save it all for another occasion. But it is connected with my other 2 points. The first one is that if this is an indication of the way ahead in terms of US transfer pricing, then there is going to be trouble ahead in terms of cross-border disputes, because I think it is entirely inconsistent with the 2017 OECD transfer pricing guidelines. And the third point is that if Judge Lauber's comment that there is no support for Koch's argument in law, fact, economic theory, or common sense is a fair statement, then I think that that is an accusation that could equally be levied against the 2017 OECD transfer pricing guidelines. The reason that I say that is this, that it is of course true that DEMPI functions as such were not invented with the 2017 guidelines. It is simply a stylized presentation of specific functions that are performed in the context of intangibles. So those have always existed. What is different in 2017 is the consequence of the DEMPI analysis. And the most significant part of that is that legal ownership is no longer a relevant criteria. What is important is the performance of those functions. And you only get the benefit of legal ownership if you have performed those functions. And if that is what economic substance means, the 2017 guidelines tell us that taxpayers are obliged to apply that. This is not something that can merely be invoked by the tax authority, the commissioner in the Koch case, in order to challenge transfer pricing. Actually, that is what taxpayers have to apply. And the fact that marketing was undertaken, whether it is by one foreign affiliate of Koch or another, doesn't really matter, because that is a DEMPI function to which profit return on the intangibles must be attributed. The difficult question, of course, is going to be how much. The other interesting question that I think that it throws up in this context relating to the supply points, and that is that Clark said, well, they just bottled the Coke and put it in a truck and sent it off somewhere. But that was done under license. And the question is that activity under license, taking Coke's secret formula and mixing it in exactly the right way that they do and getting it into the cans in the way that they do, is that an exploitation of Coke's intangible? So very interesting question. What is actually an exploitation function for DEMPI? Because if that is such a function, it is entitled to its share of the intangible return. My fourth point, if I'm permitted to make that before we move on, is a very interesting one which relates to Koch's appeal connected with the question of the previous agreements with the IRS about Koch's arrangements and fairness. And I think one of the things that we're seeing more and more in this area, particularly these very high value cases, is challenges not necessarily on the basis of the transfer pricing law itself, but under administrative law principles, or constitutional as it happens in the Koch case, in order to challenge these types of decisions. So on that,
thank you very much, Jonathan. I think that the points you raised, we might actually take them up also with Matt in the wrap-up session. But in the interest of time, I think we will move to Canada and to Cameco and AgraCity. And I will turn to Al. Please, Al, the floor is yours.
Thank you very much, and good morning, everybody from Toronto. It's a pleasure to be here, and thank you, IFA, for inviting me to do this presentation. I'm going to be talking about, or I'm supposed to be talking about, two cases, Cameco and AgraCity. But to make this presentation very focused, I'm going to talk largely about Cameco, because AgraCity simply applies Cameco. AgraCity came after Cameco. Cameco is a big case. So I'm going to focus almost entirely on that case to bring out what the decision and the legal analysis is about. So can we go to the first slide, please, Louisa? So let me just start. That's the right slide. Let's start with the facts of the case. So the facts of this case are quite interesting. Cameco, as some of you may know, is one of the largest producers of uranium in the world. Their clients are mostly utilities in the United States. And the whole story starts in the early 90s with the decommissioning of nuclear weapons in the old USSR. And Cameco is sitting in Canada. There is decommissioning of these weapons about to happen in the Soviet Union. And as a result of the decommissioning, there's going to be all of this uranium that's going to come out of the USSR that's going to be dumped onto the world market. Cameco gets concerned about that, and they decide that they have to investigate. They look into how they can purchase this uranium that's going to be coming onto the world market so that they can manage prices. And they, together with other companies, enter into various agreements to purchase this uranium that's going to come out of the USSR. And instead of buying the uranium directly, they decide to incorporate a subsidiary in Europe. And this subsidiary ultimately ends up being Cameco Europe, based in Switzerland. And what happens is the contracts for the purchase of that uranium out of the USSR. They're the contracts on the right-hand side with the entities Tenex and Urenco. So Cameco Europe essentially signs the contracts to acquire what I will describe as a Russian uranium. So the first thing that happens is, instead of Cameco Corporation buying the uranium, they incorporate Cameco Europe, and Cameco Europe then enters into the contracts to buy the Russian uranium. And it's always understood that that uranium will ultimately be sold onto, into various markets, including Canada and the United States. There was no dispute at trial when we ran this trial, and we made no apology for the fact that the motivating factor behind the incorporation of Cameco Europe was minimization of taxes. We said we decided to create the company in Europe, in Switzerland, because of its low tax rate. And so there was an admission that the purpose behind setting up the European company was, in fact, to minimize global tax bill. The second thing that Cameco Corporation then did was it entered into a bunch of contracts where it took the uranium that it was mining in Canada and it sold that uranium to Cameco Europe. Cameco Europe essentially became the aggregator of all of their uranium around that was being mined out of various mines in the world or purchased internationally. And it became the company that then sold the uranium to their ultimate customers. And as a result of, and after these contracts were entered into, the evidence at trial, and the trial judge says this, was there was a massive and unexpected spike in the price of uranium. The market forecasts were that uranium was, at the time, you know, when these contracts were done, uranium was trading, and these are rough numbers, $10 or $12 per pound, and there was an expectation that, you know, uranium prices were going to go to $13 or $14, and Cameco Corporation thought, you know, we're going to realize profits of maybe $4 or $5 a pound that we're going to realize in Europe, so we're going to avoid some Canadian tax on it because those profits will be reported in Europe. But astonishingly, the price of uranium spiked and went well over $100 a pound over the subsequent period. So the result of which is Cameco Europe realizes a huge amount of the group profit, while Cameco Europe in those, or Cameco Corporation in those years had some losses because of operating expenses. The government of Canada, Her Majesty the Queen, of course, is utterly unimpressed with this structure and this transaction, and challenges the profit that's being reported in Europe and brings it all back into Cameco Corporation's income. And the government advances basically three arguments. So maybe we can move to the next slide. And the government basically takes this matter to trial and makes three arguments. Argument number one, Canada Revenue Agency and the Department of Justice argue that this whole structure is a sham and should be disregarded. Their argument is, look, Judge, what's really going on here is this whole uranium business is being run by Canada. Canada is the company that makes all the decisions. It decided what uranium contracts to enter into with the Russians. It decided what contracts it should be entered into with the Swiss corporation. This whole structure is a sham. Switzerland is just a contrivance. Switzerland was, to use one memorable phrase from the trial, the government argued, was just rubber stamping contracts that were entered into by Canada, meaning Canada is really running this uranium business. It belongs, it is entitled to those profits. So, Judge, the whole structure is a sham. You should set it aside. Taxpayers' argument that we made was we have a precise definition of sham in Canadian law. We don't adopt the American definition of sham. We don't allow Canadian courts to engage in judicial gerrymandering by reading in vague notions of substance and allow that sort of touchy-feely view of the law. A sham contract under Canadian law is based upon the doctrine of sham as has emerged in the UK, where the government has an obligation to show deceit. The government has an obligation to show that these contracts aren't legally valid. They're not real contracts. That what was really going on was something other than the contracts. We are a very specific, precise definition of sham. And we argued that what the government was trying to do was expand our definition of sham to incorporate notions of economic substance and tax avoidance. And our courts have consistently rejected the definition of sham. The court agreed with us and said there's no sham here, these contracts are real. And the court basically refused to allow, they basically refused to allow our sham doctrine to become sort of a soft GAR. They said the GAR is a completely different creature. It's not been invoked here, and rejected the government's sham argument. The government's second argument was recharacterization. I'm not going to go to the first slide in the interests of time, but as you know, Canada's transfer pricing legislation has two limbs. The first one is the traditional transfer pricing test, where it's just basically look at the terms and conditions and see if they're market. That's the first element of our transfer pricing legislation. We then have a recharacterization provision, which applies in very narrow circumstances. And the government said that that recharacterization applied here, and this was their argument. Their argument was, look, Judge, if Cameco Switzerland was an arm's length entity, Cameco Canada would never have done these transactions with them. Cameco Canada would never have allowed the contract between, the contract with the Russian company to be placed in Switzerland. And also, if Cameco Switzerland was an arm's length entity, an unrelated entity, Judge, argued the government, Cameco Canada would never have entered into contracts where they sold all of their Canadian production to them. The Canadian production would have stayed in Canada and would have ultimately been sold to the arm's length entities by Canada. So using the recharacterization provision, they argued that the court should simply disregard the existence of the Swiss company, disregard all of the contracts that were entered into, disregard all the legal relationships, and simply tax the transaction as though Cameco Canada sold the uranium to the third parties, and therefore all the profits are taxed in Canada. The court rejected that argument. And this is probably the most important teaching from these cases. This was the first case in Canada which tested our recharacterization provision. And that's why this is probably the most important transfer pricing case in Canada. The court said the question is not whether Cameco Canada would have sold the uranium to Cameco Switzerland if they were unrelated parties. The question is whether the type of transaction that was done, which is in the first instance, the placing of the Russian contracts in Switzerland, is that the kind of thing that arm's length parties do? So the test is not whether these parties would do the transaction. The test is the transaction one which is commercially normal? Do these types of transactions happen in the open market? And the court said, of course, these types of transactions happen in the open market. And with respect to the Russian contract, the court said, companies will give up corporate opportunities to other companies for the right price. So if Cameco Canada were offered the right price for the Russian contract, it would very well give it up for the right price. And the court said, that's the question. And because these were not so-called in-the-money contracts, there were no accrued profits or anything, allowing the Swiss company to do the contract was perfectly commercially normal. And then with respect to the sale of uranium out of Canada to Switzerland, the court said these contracts, and the court looked at the actual contracts pursuant to which the uranium was sold, the court said these look like contracts that happen in the open market. These, and we called expert evidence, and we said, here's a uranium executive, here's a transfer pricing expert, here's somebody who is an industry expert. And we said, and the contracts that happened between Canada and Switzerland were exactly the types of contracts that happen in the open market. And we said, the only issue in this case, Judge, really is whether the terms and conditions of these contracts are arm's length. The other stuff is just noise. The sham argument and the recharacterization argument really are quite beside the point. The judge agreed. The matter went to the last item on my slide there, the traditional transfer pricing rule. The trial judge heard evidence from experts on the pricing in the contract and concluded that the prices were all market and allowed Cameco's appeal, and Cameco was successful on the whole thing. The government appealed to the Federal Court of Appeal. Louisa, maybe we can go to the next slide, please. And when the matter went to the Federal Court of Appeal, the government abandoned their sham argument. They didn't pursue it. So they dropped the sham argument, and now the case became a pure transfer pricing case. And the government's big argument was recharacterization. And this is what they told the Court of Appeal. They said to the Court of Appeal that the trial judge had made an error of law when he said that the question was not whether Cameco Canada would do these transactions with Cameco Europe if those two are unrelated parties, that the government argued that is the right test. The right test is not whether arm's length parties do these types of contracts in the open market, because the government's argument was, we're here to test whether the profits earned by Cameco Canada would have been earned by it if Cameco Europe were an arm's length party. And the Court of Appeal rejected that argument and said, look, the language of the provision refers to persons dealing at arm's length. It's asking, would persons dealing at arm's length, notional market players, would those people do the types of transactions that are being examined? So the focusing on the specific language of the text, and then looking at the OECD guidelines, which say that recharacterization is permitted, but in very limited circumstances, and looking at the technical notes and the government's own explanation of the recharacterization legislation when it was first introduced, looking at all of that, the Court of Appeal dismissed the Crown's argument, the government's argument, and said, no, the trial judge got it right. And then the court looked at, the government also made an argument that the trial judge had made an error of law when he applied the traditional transfer pricing argument. But that argument, there was no conviction in it. I mean, it was made as a Hail Mary pass, and the court kind of saw that and rejected that as well. And Cameco was successful at the Court of Appeal. I should tell you that the government then sought to take the case to the Supreme Court of Canada, and the Supreme Court of Canada recently refused to hear the government's appeal, and therefore the decision of the Federal Court of Appeal is now the state of the law in Canada. Louisa, can we go to the next slide, please? So I'm going to just pass over Agra City. Let's keep going. Next slide, please. And then the next slide, please. So let me just talk about Cameco, because the teachings in Agra City are exactly the same. Agra City, basically, there's a somewhat different fact pattern, but the legal principles that emerge are identical. So what is all this about? What does Cameco teach us in terms of the landscape in Canada and globally? So the first thing that I say to the international audience that's listening to this presentation is, we in Canada, our courts have really not been willing to accept statutory interpretation the way it's been done in the United States and in many European jurisdictions. Our courts have been almost fundamentalist in insisting on commercial certainty when it comes to tax laws. So they refuse to accept vague notions of substance and vague notions of residency and sham, which American courts tend to do quite liberally. And that's why I don't say this is a criticism of the United States courts, although I think it's a fair comment, is there's far less certainty in US tax cases than there is in Canadian tax cases. We are, and I don't view this as a pejorative term, others do though, we're a much more form-based jurisdiction. Our courts are very careful about drawing a distinction between legislative functions and judicial functions. So the courts here applied that philosophy when it came to our transfer pricing legislation. And what they did is they refused to allow transfer pricing to become about avoidance. The teaching in this case is transfer pricing legislation is not anti-avoidance legislation per se. We have the GAR. That is what, if the message to the governments are, if you don't like a particular transaction because you find it to be abusive tax avoidance, don't invoke transfer pricing legislation and try and force fit it into the regime to get a result. Use the GAR. And the government here didn't use the GAR for a very good reason, because there was nothing in these transactions that was objectionable from a policy point of view. You are allowed to incorporate a subsidiary in a foreign jurisdiction. You are allowed to allow it to do transactions and carry on business and enter into contracts, even if it is to minimize taxes. So the court was super careful in making sure that that didn't happen. Interestingly, Cameco was referred to in the Glencore decision in Australia in the first level, but not on the appeal. In fact, it was really interesting because when we argued the case in the Court of Appeal in Canada, we took the trial decision out of Australia, Glencore, and we told the Court of Appeal that our trial judge got it so right that even the Australian judge thought that there was merit to this, which, you know, the Court of Appeal in Canada found that somewhat interesting, that a Canadian trial court decision was being reflected in the thinking in Australia. I think that that kind of I'm just going to finish this with this comment. I want to stay well within my 15 minutes. What you know, and I'll tell you what's interesting about this case. When I think about Canadian transfer pricing litigation and court decisions, and you know, and I argued the GlaxoSmithKline transfer pricing case in the Supreme Court, and argued General Electric, and then argued Cameco. It's very interesting to me as a Canadian lawyer how, when I look at all our cases, we tend to be very careful with things like guidelines. Our courts are you know, they regard, you know, as one judge said in a conference, he said, you know, I have to read the legislation in Canada, and yeah, I'll pay attention to what the champagne sipping crowd at the OECD thinks when they write these guidelines, but that's not our law. So there's a tepidness to holus bolus reading guidelines into the legislation. They listen to it, they pay attention to it, but they're very, very careful in adopting it, you know, entirely. The second big thing that I've noticed about Canadian law that's a bit different from the more global landscape is Canadian transfer pricing cases very much think about transfer pricing cases the way lawyers think about transfer pricing. While my sense is, and I'm no expert on the global landscape on this, but my sense is that when I read cases out of the United States, or even some of the more recent cases out of Australia, the thinking there is about transfer pricing more from the perspective of how economists think about transfer pricing. I think Canada in that respect is a bit unique. Those are my comments on Cameco. I'm not going to spend any time on Agra City in the interest of time. Thank you.
Thank you very much. Yes, I would like to pick up a few comments, and I will turn the floor first to Guglielmo. I think you perfectly set the scene when you talk about sham becoming a soft GAR. And I think that here there is a nice contrast to make with European jurisdictions, because the notion of sham is difficult to capture. I mean, in a strict sense, also in a civil law sense, you think you can put it close to the doctrine of simulation, which is very much connected to the establishment of the facts, and that's it, and the real intention of the parties. And then you slide towards something that comes close to a GAR and sits, in fact, next to a GAR and turns into something like a substance over form approach. And perhaps to build on these comments, I would like to give the floor to Guglielmo, First of all, perhaps to dwell a bit on what we discussed the other day, the difference between actual sham and tax sham, if I may use this term, and perhaps also to discuss whether the case could have been argued on different, whether different reasons could have been brought up from the perspective of the European jurisdiction. And then I'll turn back, of course, to the US for I would say a symmetrical overview on what Al said. Yes, so Guglielmo.
Thank you, Robert. Yes, indeed, I find those decisions quite surprising for, we'll say, either a European or an Italian or maybe somebody who lives and works in a different country where we have different rules. Why is that? It's because indeed, in other countries, legislation would permit a different conclusion, and tax authority would have taken a different approach, precisely the one of sham, which in some countries is basically a tax sham, namely provisions which permit to override the commercial law, let's say, characterization. So there is no need to look at the guidelines. Is no longer a transfer pricing issue. Is just looking through the entity and disregard the entity as such, based either on a sham concept, which is either the commercial law sham or the tax sham, or by just applying a general anti-abuse rules which permit a substance over form characterization. So transfer pricing in some countries would not have been used to attack or to challenge the transactions. And also, what I find surprising from a different country perspective is the fact that one could have challenged the entire transaction on the basis also of tax residence, the tax residence of the foreign entity, or on the basis of permanent establishment, because I believe that the facts as assessed by the court in Cameco indicate that negotiations were taken not in Switzerland, but in Canada. So if Canada were to be replaced by Italy, for instance, then the conduct of a negotiation in the country and the subsequent transfer to a foreign entity would have resulted into a challenge based either on residence or on sham or also permanent establishment. So that is basically does show the different approaches that you may have. The final point is that in some countries, I don't know whether that is true also in Canada, tax authority could have challenged the transaction with a main reason on the basis of, for example, the transfer pricing rule, and then on a subordinate ground on the basis of the anti-abuse rule. So that you don't need in some country to challenge a transaction solely on one basis. You can use more layers so that if a first ballot doesn't fly, then you can use a subordinate argument. So very different approach could have been resulted in other countries. A final point is on the guidelines, that they are soft law. They are not law, as the Canadian court said, but every court looks at them in taking a decision. So it's a little bit contradictory that they have to be disregarded, but then courts look at them and take a decision based on that. So that is basically my comments Robert, thank you.
Thank you very much. And perhaps just add a quick reaction. So the PE risk and the resonance risk was never brought up in Cameco.
No, it wasn't. But let me just say one thing in response to what Guillermo said. The government here was entitled to plead the GAR and avoidance if they wanted to. There's nothing in our system that says they can't raise that as an alternative ground. They're permitted to do so, but frankly, I think they very well understood that they would not win, that they just had no case when it came to the GAR or abuse. And the evidence overwhelmingly established that this company the mine and management was in Switzerland. So there was really no residency case.
Yes, back to the US. Clark? I think you're still on mute, actually.
Yeah, apologies, couldn't find the button. So just very quick, my point about the cases that we're looking at here is that these cases have implications for APAs and MAPs. And, you know, when a country is sort of on a winning streak in terms of its tax administration, winning in court, that's relevant to their posture in MAP and APA. And, you know, the IRS has just won a big victory. I think when you go to, you know, MAP and APA proceedings where the IRS is involved, that should be taken into consideration. Another point is that US-Canada, you know, big loss, I think, for CRA, big win for IRS. That obviously changes the negotiating postures for those two countries, but they also have arbitration. And arbitration has been a real game changer, mandatory binding arbitration, where there's three people that make a decision. And I think the implications of this are slightly different, which is how are the three arbitrators going to decide, you know, sort of whether Dempsey principles, which I think were relevant in both decisions, should be brought to bear. And it's a question of what is the law as opposed to how to administer it. And so it'll be interesting to see if we ever get another arbitration out of the US and Canada, what it looks like.
Thank you very much. I will just turn to Vikram for one quick comment before wrap up to Matthew.
Thank you, Professor Danon, for this. I just want to pick up one of the points with respect to the commercial rationality test. Now, this commercial rationality test has been updated in the 2017 transfer pricing guidelines. And to be honest, it is quite complex because it requires proper analysis of options realistically available to both the controlled parties at the time of entering into the transaction. Now, this test is rather complex, but this test of options realistically available was not really applied in the Cameco case, as the court only referred to the 1995 to 2010 guidelines, which did not really provide for an options realistically available analysis in Chapter 1. Coming to the Cameco case, with respect to the commercial rationality test, like Al has already mentioned, the key question analyzed by both the tax court and the Federal Court of Appeals was whether the same transaction can be observed between independent parties, as opposed to whether the actual transaction undertaken by the particular taxpayer, Cameco here, possesses the commercial rationality of the arrangements that would have been agreed between unrelated parties under comparable circumstances. Now, the approach adopted by the Canadian courts is completely at odds with the guidance issued by the OECD in Chapter 1 if you look into paragraph 1.123 of the OECD transfer pricing guidelines, the 2017 guidelines, which basically state the opposite, where they say that you need to analyze whether the transaction taken by the particular taxpayer, Cameco here, would possess commercial rationality or not. So the yardstick to determine commercial rationality is different from a country standpoint, like a Canadian standpoint, as opposed to what the OECD guidelines provide. And here I see there is a lot of scope for dispute too, as to what is the right approach to determine commercially rationality of the arrangements. And that was the only input I wanted to make with respect to this case.
Thank you, Vikram. I think, Matt, this is the right time for you to take the floor. So what's your sense on all of this?
Yeah, I mean, very much for having me, Professor Denon. Appreciate and nice to see you again as well. Look, just stepping back from this, if I can turn to my slides here. Look, as the cases have shown, transfer pricing trends have become increasingly focused on reviewing and disputing seems to be the underlying fact patterns presented by the taxpayer. And so it seems to me that both we're seeing increasing challenges in terms of the choice of the methods used, as well as the suitability of comparables, and also the underlying structure of the transaction. And so in particular, the focus on is not only on traditional transfer pricing relating to the consideration, but also the contractual terms relating to the structure of the consideration, so i.e. the pricing structure. And the cases suggest that the tax administrations consider the price adjustments alone are not sufficient to counter tax avoidance through the arm's length principle, and that's been noted by a couple of panelists. So the focus has been to recharacterize the pricing structure of the transactions or disregard them entirely based on the powers provided through the domestic transfer pricing rules and anti-avoidance laws as well. And so just a couple of points on this, and it's been noted by, I think, 2 or 3 of the panelists. The OECD transfer pricing guidelines have been used as an interpretive aid to support the arguments, but as we've seen, this has proven complex, subjective, and somewhat inconsistently applied, and certainly criticised in the Glencore case as vague. Also, adjustments have been particularly prevalent where a tax avoidance motive is present, and sometimes this is written into the domestic law. And so it's been extremely difficult, as we've seen and as the panelists have raised, to justify recharacterisation in practice. And in particular, there are some considerable uncertainties regarding the application of recharacterisation principles as articulated in the pre-BEPS OECD transfer pricing guidelines. And that uncertainty has led to, I think, the delineation of the scope of the ALP to recharacterise transactions as being uncertain, and the courts have ruled that it's a high bar to cross for recharacterisation, and the courts have been reluctant to accept adjustments predicated on a lack of commercial rationality. We can move to the next slides. Sorry, I apologise. If we can also move to the next slide. And so that leads me to some themes of the cases under review. So in the first box, on considering the 2 examples given in the 95 OECD transfer pricing guidelines, several of the cases we've been talking about observed focus on the second of the 2 examples in supporting the case for recharacterisation, namely that the transaction lacks underlying commercial rationality and that this impedes the determination of an appropriate transfer price. However, in several of the cases, the courts have held that the requirements noted above have not been met. And it's important to note here that both of the requirements must be met. Number 1, that the transaction must be commercially irrational. And number 2, that the tax administration should be impeded in determining an appropriate transfer price. And this highlights, I think, several obstacles in applying the reconstruction provisions in practice. And for example, the observation of relationships with or between third parties with similar pricing structures seem to provide reasonable support to substantiate that a pricing structure is arm's length and thus precluding a recharacterisation of the pricing model. For example, Glencore. However, the scope of recharacterisation provisions also are uncertain, and it could be based on an assessment of whether any commercially rational party would enter into the agreement, or it could be considered to be based on whether the particular parties would enter into the transaction based on their unique facts and circumstances, including as a multinational group member. And so considering what are the arrangements that independent enterprises would enter, there are some points that make it practically challenging to find comparability and reconstruct a different or more commercially rational transaction. And some of those challenges, for example, are the counterparties have been viewed in cases as being multinational group members and not standalone entities, making comparability quite difficult. Second, in order to determine if a pricing structure is more commercially rational, it is necessary to undertake an options realistically available assessment to the parties and show that another option leads to a better risk return payoff. And also, thirdly, there is an implicit respect for the business arrangements of the multinational group as a whole. And this has been broadly been followed by the courts, so long as it's substantiated with evidence. And so this also leads on to the challenge in applying the OECD transfer pricing guidelines in practice, and which underpin this issue. And we sort of, some of the panelists have actually raised, it is very complex to apply in reality, and as Isabel noted this. And so aspects that have been mentioned is very complex to apply the risk control framework in Chapter 1, the DEMPE requirements, their relationship to the appropriate analytical framework and the evidence required to substantiate a particular position. And so the concern is, when faced with such complexities, do the courts turn to simpler or vaguer concepts in attempting to apply the underlying principles? And this could lead to subjectivity in practice and make it practically challenging to actually apply and comply with the standards. There's also in box 4 in the bottom, significant uncertainty regarding the scope of the ALP. And again, it's been raised by several members the scope to recharacterize transactions in exceptional cases. And while the scope of the ALP to adjust pricing is obvious, the purported scope of Article 9 and the ALP in relation to recharacterization and non-recognition of transactions is not as clear. And also, I'll just make a side note here that the limits and subjectivity of the exceptional circumstances in which characterizations may apply under the TPG, the guidelines, as we've noted, is practically challenging to apply. Also, I would just note here, cases have underscored the relevance of the most appropriate method test, showing that facts and circumstances must be considered in each case. For example, Coca-Cola, where the CPM method was accepted as the most appropriate based on a full review of the facts. And lastly, settlement of each case on its merits without regard to prior tax authority settlements is a factor to note for taxpayers that have received such settlements in the past. If I could turn to the next slide, just on this slide here, because of time constraints, I will just note 1 or 2 points only. To me, generally, the cases have been an assessment of the arm's length nature of the transactions. As noted, under the rules, should start with the transaction as the taxpayers have structured it, and should only be recharacterized or disregarded in exceptional circumstances. And the panelists have discussed this: substance of a transaction differs from its form, commercially rational, and impedes the determination of appropriate transfer price. But there are, as discussed, this has raised some very significant practical issues in practice, definitional issues regarding the delineation of the boundaries of what is exceptional circumstances or great caution. The circumstances in which characterization provisions are applied is important, and as seen in the cases, the absence of a third-party comparable doesn't mean that the transaction isn't arm's length, and thus implicitly it does recognise the status of an enterprise as a multinational group member, and this makes it challenging to challenge the commercial rationality of the transaction. I think contemporaneous circumstances of the business concerned, it makes it even harder to apply given the time periods that typically elapse between the time period that the adjustment applied to, when the audit was conducted, and when the case was heard. So this does imply some very significant challenges in practice. And lastly, Professor Denon, just concerned about time here. If I turn to the next slide, just in conclusion, at least from my perspective of what we've seen, attempts to adjust pricing structures have been negated by the courts. Broader reviews of the options realistically available as a means of assessing commercial rationality have been precluded by a stricter view of respecting the business's judgment inherent in the agreement. In all but highly exceptional cases, basing adjustments on pricing alone at this on the pre-BEPS guidelines seems to be favoured by the courts. However, changes to the OECD guidelines in 2017, post-OECD BEPS, where we do sort of see the risk review framework and fundamentally change the basis of recharacterization and might lower the bar by allowing redelineation of transactions, replacing substance over form. And lastly, from me, cases for post-BEPS periods may see an evolution of the approaches taken at court, limiting the ongoing application of a narrower interpretation of recharacterization provisions. Having said that, and as noted by several of the panelists as well, we do sort of see in Glencore and also the Canadian cases, there is this view that by some cases that while the OECD guidelines are interpretive and an important interpretation tool, domestic viewpoints and domestic legislation has precedence in that case. And so it will be interesting on the post-BEPS guidelines 2017 to see if that continues. Thanks, Professor Denon.
Thank you very much, Matt. And just, if you allow me to draw a parallel, of course, when you speak about the relevance of the transfer pricing guidelines, there is a nice parallel with the relevance of the OECD commentaries. But I think it is one thing to interpret tax treaties, and it is another thing to interpret a domestic legislation in light of the transfer pricing guideline. And that's where I think there is still a difference between the two. And how far actually does domestic legislation support the solution of the guidelines? That I think is a difference with tax treaty interpretation. I think what this seminar has shown is that there's a wealth of issues that could have been discussed at length. I feel actually it's 6:15. I am heavily frustrated because I would have loved to engage in several of these items, but I think we all did a very good job, and I can see that the participants are still attending, which I think is an evidence of the fact that they pretty much agree with that. As I said, it's the first webinar series of IFA. It underscores the importance of tax practice and to be able to communicate at the global level on tax practice. So we will be back, if I may say, soon with these webinar series with the same format, and we will be back also, of course, in the coming months with the international tax policy update. With that, on behalf of IFA, the Permanent Scientific Committee, thanking also the Secretariat, I wish you a great evening, and I look forward to engaging in various forums in the coming months. Thank you very much to you all, and all the best.